Hi, and good morning, everyone. Welcome to our Map Talk webinar on household debt and the coronavirus. My name is George Hammond. I'm director of the Economic and Business Research Center. And what you see now is what I used to look like back when I was getting regular haircuts. I'm joined today by Jennifer Pullen, our excellent map dashboard coordinator and senior research economist. So our webinar details, first off, the Map Talk will be recorded, and we'll have the recording up on the website later today or tomorrow morning. Also keep in mind that the conference will be conducted in conference mode, and that means that everyone except for your presenters will be muted. If you'd like to ask a question, please use the Zoom chat or send me an email anytime at ghammond@arizona.edu. Before we go any further, I want to thank our sustaining sponsors and partners. The sustaining sponsors are Tucson Electric Power, the Thomas R. Brown Family Foundations, and the Freeport-McMoran Foundation. I also want to thank our partners, the Community Foundation for Southern Arizona, the Pima Association of Governments, the Southern Arizona Leadership Council, Sun Corridor Incorporated, and the University of Arizona. Now, keep in mind that twice each month, the map dashboard is featured in the Arizona Daily Star. On the last Sunday of the month, we're on the front page of the business section. And on the first Monday of the month, we are featured in the health section. So be sure and subscribe to the Arizona Daily Star and check those out. In addition to the core indicators that you'll find on the Map Dashboard website, we also do a large number of feature articles. And we are doing these at a much more rapid pace these days. Now, the feature articles cover a range of subjects, everything from how renters fare to understanding chronic disease prevalence and incidence. We've also looked at the potential for water independence in Tucson's communities. And we also have a nice feature on how local organizations are using the map. So if you'd like us to feature your story on how you're using the map, we'd be happy to do so. Just send Jennifer Pullen an email. Now, the map feature articles are written by the map team, but some of the map white papers are also written by U of A faculty. These days, we are doing a large number of feature articles that are explaining various aspects of the impact of the coronavirus on the economy. So stay tuned for more of those. And as always, please be sure to engage with us. You can subscribe for updates via our monthly newsletter. And also be sure to click on the high frequency data link, and that will take you to some of the weekly data that I'm going to talk about in a couple of minutes. So let's talk about the key topics today. First of all, we're going to deal with the latest developments. We'll talk about initial claims for unemployment insurance, which remain elevated. We'll take a look at the national labor market indicators for April and see what that might tell us about where Arizona was last month. And we'll also take a look at some of our weekly social distancing indicators and see what those are suggesting now that the economy is beginning to open back up. Then we'll turn to consumer debt and the recovery. And we'll talk a little bit about some high frequency data that we have on consumer spending, both before and after the outbreak. Then we'll turn to the consumer debt structure before the outbreak, and then take a look at delinquency performance also before the outbreak began. And we'll finish up by thinking a little bit about consumer debt and delinquency after the outbreak. Then I'll turn it over to Jennifer, and Jennifer will talk about some really neat debt to income ratio data that will also give us a sense for how Arizona compares to other states and how Tucson compares to other Western metropolitan areas. And she'll also look at the time trends in those debt to income ratios. And all this is designed to give us a sense of how household finances were before the outbreak began. And we'll think about some of the implications that that might have for how we'll fare during the recovery. Well, first of all, as we all know, the economy has suffered a huge shock with the outbreak of the coronavirus. Now, we do have the latest data for the US for April. And what that showed was a massive shock to the US economy. The national unemployment rate spiked up to 14.7% in April. That was the highest unemployment rate that we've seen since the Great Depression. In April, the US economy lost just over 20 million jobs, and the employment to population ratio for the prime age population fell back to the level that we last saw in about the mid 1970s. So a major shock. Now, the Arizona data on job growth and the unemployment rate will be released this week on Thursday. And it's likely that we're going to see something similar happen to Arizona's unemployment rate. It's likely that it's going to spike up into that neighborhood of 14 to 15%. One of the reasons that we think that is because of what's been happening with initial claims for unemployment insurance. This gives those initial claims during the past 9 weeks. During that 9-week period, initial claims for unemployment insurance total about 550,000. One thing to notice is that the initial claims peaked in early April and have been trending down since. For the week ending May 9th, there were about 32,000, almost 33,000 initial claims for unemployment insurance in Arizona. So that's well down from the peak, but that's also about 10 times greater than the average claim during the pre-outbreak period of, say, 2018 and 2019. So unemployment claims, even initial claims, even though they're down, they're still elevated. Now, one of the things that that we've done in the Economic and Business Research Center is to start to track some other high-frequency indicators that will give us a sense of how social distancing has impacted particular industries, and we know that the outbreak has particularly affected the travel industry, especially airline travel. And this gives us a little bit of a sense of that. This is the passenger flow through TSA checkpoints. And you can see that during the week of ended March 14th, that the traffic flow through those checkpoints was about 12.5 million passengers, whereas last week the passenger flow was about 1.4 million passengers. So the passenger flow, that airline traffic, is really down massively. It's down over 90% compared to where it was a year ago at this time. And what we're going to watch for going forward is to see what happens to this the flow through TSA checkpoints in the coming weeks and months, because that will give us a sense of how airline traffic is recovering. Now, we've seen it gradually trend up, and the question is, will it continue to just gradually trend up, or is it going to start to really spike up back to levels that we last saw before the outbreak? Now, another key indicator is what's going on in restaurants. And we have some data. This data actually comes from OpenTable, and they track seated diners at restaurants, which provide them data. And there are about 20,000 restaurants nationwide that provide this data to OpenTable. And what you see here are over-the-year growth rates by week. And you can see that the seated diners at restaurants nationally in Arizona and in Phoenix were already trending down pretty significantly before the stay-at-home orders were issued. And we've seen the seated diner counts be about 100% below where they were a year ago for most of April and through the first week or so of May. But now that restaurants are beginning to open back up nationally, we're seeing national seated diners start to grow again. And we've seen a little bit bigger increase both in Phoenix and Arizona. So this will be a key consideration, how the seated diner traffic starts to rebound as we go forward in coming weeks and months. So be sure to click on the high frequency data link on the dashboard, and that will take you to the latest weekly data that we are tracking. Now, as we think about consumers and how consumers are doing, one good place to start is with some high frequency data on card-based purchase transactions by households. So these are card-based transactions, and they include debit card transactions and credit card transactions. Now, these are all measured relative to early January. So here again, you see that the card-based transactions really start to drop off as we go through March, and they reach their lowest points as we go through early April. Notice that as we get into the second half of April, the card-based transactions start to rebound a little bit, up from the lows of declines greater than just a little bit greater than 30%. We're now up to about 20% roughly for Tucson and Phoenix, 20% below where they were in early January. So you can see those significant impacts on consumer spending and shopping as we went through the stay-at-home orders and the initial phases of the outbreak. But the good news is that consumer spending has started to rebound a bit. So let's talk a little bit about consumer debt trends. Now, this shows data for the US, and keep in mind that it's before adjustment for inflation. And these are loan balances by type. And we're tracking data here from the Federal Reserve Bank of New York. And they provide data on mortgage balances, home equity revolving balances, auto loans, credit cards, student loans, and other balances. And the first thing to notice is that most of the debt is mortgage debt, about 70% in the first quarter of 2020. Next largest is student loan debt, followed by auto loans, and then credit cards. The second thing to notice is the trend here. We saw the big increases in consumer debt during the run-up to the recession of 2008 and 2009. Keep in mind that most of the debt had already been accumulated by the time the downturn began. And we still saw some increases even after the recession began in early 2008, but not so much. Thereafter, during the downturn, we saw debt levels gradually trend down until the recovery begins. Actually, a couple of years after the recovery begins, we start to see the debt levels rise again. And we are now at debt levels unadjusted for inflation and unadjusted for the number of people in the US. We're now at levels that are well above the peak before the Great Recession. We'll take a look at per capita data in a couple of minutes. Now, one thing we want to keep in mind as we think about debt is delinquency matters. This tells us the loan balances that are seriously late, meaning 90 days or more behind. And the highest levels of delinquencies are for student loans, followed by credit cards, then auto loans, with mortgage and home equity revolving lines much lower. Now, for the credit card lines, mortgages, auto loans, and home equity revolving, we're all well below the peaks that we saw during the and just after the recession of 2008, 2009. But you do notice that credit card debt delinquencies have begun to trend up, as have auto loan delinquencies. So that'll be something to keep an eye on going forward. Now let's take a look at this consumer debt per capita and across a selection of states. And when we say per capita, this is based on the population with a credit card report. And these values are, again, on a per capita basis in thousands of nominal dollars. So that's before adjustment for inflation. Now, California has the highest per capita debt levels, followed by New Jersey, but then Arizona comes in third with the other states somewhat below. For most states, consumer debt per capita is well below the peaks during the last recession, but not for all. Notice New Jersey is actually fairly close to that prior peak. California also has relatively high per capita debt levels. And keep in mind that some of this will be driven by the house prices in those given regions. It just individuals who want to buy homes in very expensive locations are going to have to take out much bigger loans. Overall, for most of the states, the per capita debt levels before we adjust for inflation are below the prior peaks. Let's take a look at delinquencies here again. Notice that delinquencies peaked after the downturn of 2008, 2009, and for all of the states in this sample remain well below those prior peaks. And the same is true for Arizona. It's about in the middle of the pack here. We can get another sense of these delinquencies now considered as a share of debt line. So each debt line is, if an individual has a credit card, that's a debt line. And these are delinquencies defined somewhat more liberally. These are delinquencies which are 2 months or more late. The advantage here is that we have data for all states. And the states that are shaded darker have higher delinquencies as a share of overall debt lines. And what you notice is it's really the Sun Belt that's been that tends to experience higher delinquencies as a share of total debt lines, and that does include Arizona. But the highest delinquency rates are for those southeastern states like South Carolina, Georgia, Mississippi, Alabama, Louisiana, Tennessee, and Oklahoma. So that's the latest quarterly data and a little bit of the monthly data. Now, when the Federal Reserve works with this data, it's actually drawing off a larger database run by Equifax. And Equifax does a nice little report that gives weekly trends for U.S. consumer debt. And they break it down by the same categories we've already seen. But the weekly data, I think, shows us something interesting, at least in terms of these debt trends. So for the revolving debt, that includes bank card and private label credit card. So think of a private label credit card as a Macy's card. The non-revolving credit includes autos, student loans, and other types of loans. And what we see for the revolving credit is a big drop-off with the outbreak of the coronavirus. And that's likely reflecting the big drop-off that we saw in consumer spending. Where we're not seeing much of a drop-off, but are seeing a plateau is in the non-revolving credit, which includes the auto, student loan, and other loan balances. And again, these are non-mortgage balances. So what we are seeing is a slowdown in revolving credit. Non-revolving has basically plateaued so far during the outbreak. Now, this weekly report from Equifax is free. You can visit their website and download it and look at all the detail that's there. They also do report the weekly data on delinquencies, but you want to keep in mind that it takes time for the delinquencies to become apparent. People have to start to miss their monthly payments before it will show up in the data. So that's something that we'll be tracking going forward, but there's not much in there just yet that's particularly concerning. What we are concerned about is that these delinquencies will really start to rise as we go forward over the next couple of months. So with that, I'm going to turn the presentation over to Jennifer Pullen, and she will take you through the remainder of the presentation. So Jennifer, I'm going to pass it over to you now.
All right, great. Thank you, George. So today I'm going to talk about some of the data, a lot of the data that George talked about, but it's going to be aggregated up to the county, MSA, and state level. So we can look at how Tucson compares to peer metros, how Arizona compares to all of the other states around the Western US. So this is going to allow us to explore that debt to income level during the prior recession and the recovery, and what those debt to income ratios might mean for the COVID-19 downturn. Next slide, please. So we'll start with just basic, what is the debt to income ratio? So when we think to debt to income, this is typically that debt owed by the household. So those different categories that George talked about today, your mortgage, your auto loan, and what is that relative to your household income. So just note that the debt to income ratio that we're going to be talking about here in this section excludes student loans, and it's going to be aggregated up to the county level, the MSA level, and then the state level as well. So we'll take of the household sampled, what was their debt relative to their household income in those regions, and then aggregate it so we can look at those larger geographic scales. So typically we think lenders use debt to income as someone's ability to repay their loans. So when you get a mortgage, they look at your debt to income ratio and determine whether you will have the ability to repay that mortgage. And then this is all aggregated to a regional perspective. So sluggish recovery from the 2008-2009 recession. So what the data, the recent research has shown us is that regions with higher debt to income ratios prior to the 2008 recession were slower to recover from the last economic downturn. And so we'll explore what that means for Tucson, Arizona, and the West in general here with current debt to income ratios. And so we'll see that the Western states are more leveraged. There's significant variation among counties in Arizona and across the US as a whole. Tucson has currently the second highest ratio, income to debt ratio among its peers in the West, but we are less leveraged than we were prior to the 2008 recession. Next slide, please. So we'll start at the state level. So in 2018, Arizona posted one of the highest debt to income ratios among the US at 1.8. Among the Western states, Colorado and Idaho also had debt to income ratios of 1.8. This means that total debt from those sampled exceeded income by 80%. Among the Western states, Texas posted the lowest ratio at 1.1, and nationwide the debt to income ratio ranged from 0.4 in North Dakota to 1.9 in Maryland and Hawaii. So overall, as you can see from the map, the Western states are more leveraged than the nation. The national debt to income ratio is just over 1.1, is just over 1 in the fourth quarter of 2018. So all of the Western states significantly more leveraged than the nation as a whole, with the exception of Texas. Next slide, please. So if we break that down by county in Arizona, we can see that there's significant variation. Greenlee County there is blacked out. We don't have data available for Greenlee County. When we look at the smaller geographic region, it's clear that there's wider variation. We see that La Paz County posted the lowest ratio of 0.8, while Pinal had the highest at 3.46. This means that debt in Pinal County was 346% of income. So debt owed was 346% of income earned. And so research on our previous recessions has shown that the debt to income ratio in areas with this higher ratio recover more slowly. So here we see that Pinal's got really high ratio, as well as Mojave and Yavapai County. Next slide, please. When exploring the Tucson metropolitan area compared to its peer metropolitan areas, you can see here that both Tucson and San Diego have the second highest ratio at 1.8, with Colorado Springs having the highest at its 2.1. It's important to keep in mind that a lot of this debt to income ratio is driven by both debt. So regions with higher home prices may have higher to debt to income ratios, but it's also driven by wages. So regions with low wages may have higher to debt to income ratios. Next slide, please. So nationwide, the household debt ratio reached record high prior to the 2008 recession. You can see here that peak, top of the graph. So we saw a sharp increase here leading up to the 2008 recession. This was in part driven by the housing boom. Then household debt began to fall following the recession. The decline was driven by several factors, but the two key reasons were a reduction in personal expenditures and loan defaults. So there were a lot of home defaults in the years following the beginning of the Great Recession, and so that helped to drive down the debt to income ratio across the US. Next slide. And so it's important when we look at this graph to keep in mind that the Western states and many of the Western peer metropolitan areas are more leveraged than the US as a whole. So these numbers are going to be a little bit higher when you look at them overall, with Tucson's debt to income ratio at 1.8, but overall the general trend has followed the same pattern as the nation, with those steep inclines prior to the 2008 recession, especially for the Phoenix metropolitan area, and then a decline following the last recession. Next slide, please. When comparing Tucson's debt to income ratio in 2008, so prior to the last downturn, to the last year of data that we have available here in 2018, you can see that Tucson, there in the bottom, has a lower debt to income ratio currently at 1.8 than it did prior to the 2008 recession, which it was 2.1. All of the Western pure metropolitan areas that we compare Tucson to have lower debt to income ratios in 2018 fourth quarter than they did in 2008 prior to the Great Recession. So this means that they're in a little bit better shape to weather the COVID-19 recession, and hopefully the recovery for these areas won't be as sluggish as it was when we came out of the 2008 recession. Next slide, George. So the main key takeaways from this is that Arizona, Phoenix, and Tucson economies have suffered a huge shock. So we have added that high frequency visualization on the map dashboard. You can click on that and track all of the weekly data that we're exploring in the Economic and Business Research Center. Arizona per capita debt levels were high compared to many states before the outbreak hit, but delinquencies were closer to the middle of the pack, as George discussed. The Western states tend to have higher debt to income ratios. Sunbelt states tend to have higher delinquency ratios. So Western states have higher debt to income ratios. This can be driven by higher home prices, decreased lower wages in some cases. And then also the Western states have higher debt to income ratios, not just relative to some of the East Coast states or the Northern states, but relative to the nation as a whole, and quite a bit higher when you compare the nation at 1.1 to Arizona at 1.8. Current debt to income ratios are lower than before the 2008-2009 recession. This is important because it suggests that prior research suggests that the lower your debt to income ratios are, the better able a region will be able to weather economic recession. And then significant variation in the debt to income ratio exists nationwide. So it really is dependent. When you look at breakdowns for the county, Arizona counties range from 0.8 to 3.5. Significant variation really depending upon what the makeup of that county is in terms of their industries and their wages and their home prices, or other debt like credit cards, student loans, etc. And I think now I'll turn it back to George, and he'll talk about some of the products the Economic and Business Research Center provides.
Well, thanks, Jennifer. In addition to the MAP dashboard, be sure to keep up with the latest offerings from the Economic and Business Research Center, including our Arizona's Economy smartphone app, our Arizona's Economy online magazine. That's one place where you can get access to forecasts and analysis on what's happening with the state, as well as high frequency data. Don't forget the dashboard, as always. And finally, keep in mind that the COVID outbreak is having an impact on the NAFTA area and more generally the globe. So trade will be impacted, and our Arizona-Mexico Economic Indicators website will keep you up to date on the latest developments in Arizona's role in border trade. So with that, if there are any questions, you please feel free to type them into the group chat. Jennifer, I don't have any questions in my email. Do you have any questions in your email box? Doesn't sound like Jennifer does. So with that, I will thank you all so much for attending the Map Talk webinar, and we look forward to seeing you next time. Take care and stay safe.